right, welcome everyone. Welcome to our bonus class. I am so excited to have Evan here with me to talk about financial investment and advising and just getting our money together for our future selves. So I am going to turn the floor over to him to introduce himself and share a little bit about himself and his company and what he does. And then he's gonna share some good information with us today. And then we'll have some time for Q&A at the end. So Evan, take the floor. I will say that I know Evan personally, so it's been just a joy to work with him. He's been helping me get my money together. So I do try to practice what I preach, although it's hard. I felt very convicted as we've been doing these classes of things that that I can work on because we're all works in progress. But that said, again, I'm really thrilled to have Evan here today. So tell us a little bit more about you and your company and what it is that you do.
Absolutely. And thank you very much for the intro, Esperanza, and thanks for inviting me to speak today. I'm excited to talk more about money and finance. It's really my everyday, and it's also a passion of mine. I started my firm, Tetelestai Capital, in 2021, and really the basis of my love for finance, and then also the main driver of me starting my firm, is I've noticed throughout the years, financial literacy is something that we don't get taught regularly in school. And we, even in the finance world, business world, there's a lot of avenues of finance that don't even really get discussed much. And so I'm looking at from that perspective of being in finance my whole career, and then looking at people like my siblings, my parents, friends and family. I'm noticing there's so many gaps in their financial literacy. And I had just thought, I was like, I would love to help as many people and business owners as I can understand their finances and help them out in their future selves and their future families for years to come. And so I started my firm in 2021, like I said, and haven't looked back. It's been a great ride. And I really focus primarily on individuals and then small to medium-sized businesses, helping them achieve financial success, whether that's financial planning, investments for them, or maybe more deep dive where it's financial cleanup and helping them organize their finances for future growth, whether that's a bank loan, bringing on investors, or potentially selling their business. So really have a full spread of financial knowledge, and I'd love to share that with you guys today.
That's awesome. How long have you been in the finance industry before you started your company, and what made you see the need to start something special aside from maybe your previous experience?
Absolutely. Great question. So I started out really diving deep into financial knowledge around 2014. I was still in school at the time, and I had a friend of mine who introduced me to investing. I knew a little bit about investing at that time, but I didn't know full-on exposure of investing in markets, investing in individual stocks. And so when he introduced me, I fell in love with it right away. Started reading as much as I could on that. And when I left school in 2016, I went into accounting, and most of that was driven by I wanted to understand financial statements, because if you understand financial statements, that's the language of money, that's the language of business, and the language of investing. And I thought that was the most relevant way to start my career in finance. So in 2016, I started in accounting. I switched more towards financial analysis, and then I switched more towards financial advisory. That was really what my career progression looked like. So I understand the intricacies of accounting, understand how to talk with people about their finances, and I understand how a business runs with their finances. So I have all those bases covered.
Wow. And you're a CPA also, correct?
Yes, I have a CPA license, and then I also have the CFA designation, which really is a chartered financial analyst. So I have a lot of very in-depth knowledge in specific areas in finance, and especially for investing, that comes in handy for understanding financial statements and evaluating companies.
Yeah. So you have like over a decade of experience. And our class that we're in right now is talking a lot about financial literacy. What is a CPA, a CFA? Sometimes we might see these words and not really know what that means, and the benefits of working with someone with these certifications versus, Uncle Bob, who's maybe did tax for 5 years or something.
Right. No, that's something that I found in working in finance. A lot of the terminology, I feel like they use it to try to sound more sophisticated and complex. But really, at the end of the day, a CPA is certified public accountant. What they do, usually it's two paths. One of them is the tax side. So you may submit your tax forms to them. They'll help you file your taxes. They are really good at helping understand tax consequences for things, whether you're a business owner or an individual. And usually that's one route CPAs take. The other route is more of audit and advisory, I would say. And so that route is a lot of understanding a company's financials, make sure they don't see any signs of fraud or anything like that. And that's usually for investors when they want to understand that the company they've invested in, whether that's a stock or a private company, is running properly, and they may not have the in-depth knowledge to do that. So they'll hire a CPA to go in and try to understand that for them. So that's usually what a CPA does, either taxes or on the audit advisory side. And then the CFA, that is something that it is more of a specialized designation, and it's really for people that have really in-depth knowledge on finances, especially from an analysis perspective. So if you want to understand how financial statements, how that correlates with the valuation of a business, or if you're trying to analyze a stock and try to see where the stock's heading in the future based on fundamental analysis is what it's called. But basically that's boiled down to looking at financial statements, understanding them, understanding what the company would like to do in the future, and trying to map that all together on a financial side. That is really what the CFA comes valuable. And so I chose to get that because someone had mentioned this in the past of the CFA is like the Jedi of finance because they're really specialized skills. And I really wanted that. So I went for that after I got the CPA.
I love that. Well, I'm interested in what other information you have to share with us. We have a few entrepreneurs in the class. And so that sounds like very helpful information to know from the business side of things. And we have just some average folks that are just looking to make improvements in their finances and reach their financial goals. What can you share with us today about the basics of what we need to know?
Sure, definitely. So there's so many places we can start with, but I really like to start with individuals when I get to know someone, whether it's a client or a prospective client or just someone I'm talking with, understand what their goals are with their finances. And whether you've sat down and made a financial roadmap for yourself or have some budget goals that you're aiming for, or if you're just going in it completely blind and just living paycheck to paycheck, it's really important to try to understand where you're heading towards. And that's one of the first things I ask people. That can take a lot of different routes. Some people say, I want to have a beautiful home, a vacation home, this luxurious life. Some people say, I just want to save up for my children's college and live a comfortable life. And so no individual circumstance is the same. A lot of people have different circumstances. So that then takes multiple different paths for me to talk through. But a lot of things I see with individuals are concern for retirement and future savings, and making sure they have enough for retirement. That is something that I hear day in and day out from younger people and older people. And so I like to help coach people through what that process looks like. And then also another concern people have either on the budgeting side or on what you call spending. And that would be whether that's credit cards or not feeling like they are saving enough, or maybe they're living way above their means, and to try to navigate through their financial situation in a way that's appropriate for them, but appropriate for their long-term goals. That's usually the two routes I focus on the most after I hear their financial goals, because like I said, it's really important for people to understand where they're heading, but also those like very intimate details on how's your spending, how's your saving, what's your future life going to look like if you continue on this path versus this path is really important. And sometimes that's very eye-opening for individuals as they get deep into it, because it's, like I had said earlier, it's not something we learn a lot growing up. And so once you're in it and you start understanding your finances, that can either be a stressful situation or it could be a liberating situation. So I like to help guide people towards the more liberating eventually.
That's awesome. So you said there's no right or wrong, and that your goal is be able to just help people figure out what their goals are and the path on how to get there. What are some of the common challenges that you see people facing when they start to come with you? Is one question I have for you.
Mm-hmm. Yeah, it's a good one too. A lot of individuals I've worked with on the investing side, especially as you're younger, ideally you would like to invest as much as you can as early as you can, because that gives you a long runway for your investments to grow. And when I say investments, that could be stocks, that could be bonds, that could be your own company, but in some sort of investing form, you should be doing that as early as possible and as much as possible. And I talk with friends and family who are, especially in their younger years, maybe 2 to 3 years out of school. That's like prime time to be investing, because if you can leave your money invested for 30 or 40 years, that has dramatic impact for your end results versus trying to do 5 or 10 years. But the problem arises where individuals, especially in the younger stages of life, they like to spend money, they like to have fun, they like to travel, they like to have nice things, which is all good things. You should definitely reward yourself that you're working hard. But you should also reward your future self by investing, and investing aggressively in these younger stages, because usually that's either when your kids are very young or before you have kids, before you have major life expenses come up. If you can put as much money as you can aside early, that is something that it's hard to get people to do it, but your future self would thank you. Additionally, I also come into people on the opposite spectrum where maybe they are in their 50s and they don't feel like they've saved enough, and they are scared, I would say, to what's the next 10, 20 years are going to look like, because I haven't saved enough. A lot of those conversations revolve around how can we get as much saved now as you can without being detrimental for your current self, but then also what are the avenues you can do to give yourself a little bit more runway. And that might be when you're 60 working part-time versus fully retired, or if you're working in a job that is not as manual with your hands or body or anything like that, maybe you have a little bit more runway to work with, and maybe you can work an extra 5 years where normally people maybe are retiring at 60 or 65. Maybe you can work into your 70s, and that gives you some runway. If you started investing aggressively at 50, if you retired at 70, it still gives you 20 years of really good time to let your investments grow, let your savings grow, and get a healthy retirement at that point. So trying to get people out of a fear mindset with that, and trying to help them to understand that, yeah, you might be in your 50s and it might not be what your ideal situation would be if you were looking forward, but it's not the end of the world. We can make this happen, and trying to coach them to see what that looks like too. Those are the two problems I come across a lot, are trying to save early enough, and then when you get to later stages of your career, trying to make the best out of it with the time you have, which is, I mean, as we've seen with modern medicine and just health in general, like it's not uncommon for people to live into their 80s, 90s, and even hundreds. And if you're only 50, I mean, you're only halfway through. So you can definitely have time to let investments grow if you're at that stage.
Yeah, so sounds like you're able to provide a different perspective and support people moving out of that fearful mindset of like, it's too late for me.
Right.
And know that you still have time, and like you said, make the best of your time. what is helpful to help people believe that? Because that's something that that even I have struggled with, and I'm not 50 yet. I won't say how old I am, but I'm not 50 yet. Like, okay, I've started too late, or I've just, like you said, didn't save enough up until this point in time. What helps people believe that there's hope for themselves and shift?
So, a couple things I like to show people. One of them is basically a compound interest chart, and it really shows if you had a starting balance, let's say of $10,000, what that could look like at a certain return average every single year for 20 years, 30 years, 40 years. That growth trajectory is pretty aggressive, especially the longer you leave it. That's one thing I like to show people. Just say like, hey, if you only have 20 years before you would like to retire, even in 20 years, this is what could happen. If you consistently, even if it's small chunks of money every single year for 20 years, and then invest it more aggressively, over time, that could do extremely well, even in 20-year time frame. So that's one avenue I like to take. Another avenue is just having, whether it's quarterly check-ins or semi-annual check-ins, to try to keep people moving along. And in the beginning, it's going to be hard because it's, even if you're looking out 15, 20 years, that's really hard to try to conceptualize now. And so trying to have routine check-ins where we look at your financial situation. I have a dashboard that I put together for clients, and it basically shows, I call it the net worth tracker, but it basically shows how your net worth has been moving over the last 3 to 6 months, depending on how long we've met. And it's not a huge time frame, but if you see gradual improvements in that time frame, that's encouraging, and that makes people say, all right, I want to do this for the next time we meet. And you do that over several years or several decades, that is going to be cutting a huge chunk of time into much smaller bite-sized ones that you can easily track and understand, like, what I'm doing is actually progressing me forward, versus talking to someone and saying, all right, this is what your savings plan should be, and I'll see you in 20 years when you retire. That's a lot harder for people to keep on track, but then also to really just fully grasp, like, what I'm doing is actually moving me in the right direction, and it keeps people motivated to keep going that way.
Right. Yeah. What would you say for the person that is just completely overwhelmed with their finances and they don't know where to start? What would be like your first steps you'd recommend?
So definitely the first step I would say is, let's write down everything, whether it's your bank accounts, your investment accounts, your credit cards, everything that you've got out there right now. Let's put it all on the table and see where you're at. This is your starting point. And then from there, we start looking at what are our financial goals. And then we have financial goals on one end, your starting point here. How do we bridge this gap, and what does that look like? And so I would say best thing to do though is put everything out on the table and try to understand it. Some people I've talked to, they're not even understanding where their financial position is, because they may have credit cards they forget about. You talk to people that like, oh, this went to collections and I've just put it out of sight, out of mind, which that's reality of some people's situation. And then some people, they are doing really well for themselves, but they haven't tracked any of their finances, and they have bank accounts in places. They're like, oh, I forgot I had this too. Like, it's a lot of, you'll be surprised at how many people I talk to that have just no organization on their finances. So
Yeah.
trying to bring some organization to that and just have a starting point is where you start. And that hopefully that might add some stress initially, because you're like, oh, wow, I forgot this was here, or I forgot I had this balance on the credit card. But that then can give us a place where, okay, everything's on the table. There's nothing unknown here. And that a lot of fear is because of unknown stuff. Once that's all out, then we can start mapping out what we need to do next.
Mm-hmm. What would be different between, let's say, because everyone hopefully is applying everything that they've learned in class, which we have talked about getting organized with your money. And so they've got their maybe goals, and they are facing any debt or collections or any of that, and making their plan to tackle those things. How would they know that this is something I can do on my own versus now I might need to get, a financial advisor? And who is the type of person that should get a financial advisor. Me growing up, didn't even know that that was a thing. Never heard of it until like much later into adulthood. So how do you know when you need extra help and who should get the extra help?
Definitely. I would say for the majority of people, it is important, especially in the beginning stages, to get some sort of financial guidance. And the reason being is there's a lot of emotion involved with money. And if you're the person driving the ship and there's a lot of emotion and you have a lot of emotion tied to the ship that you're driving, you might not make the best decisions for your long-term self because you're really focused on the short term. And that might be because of stress. That might be because of, hey, I'm doing really well. I want this, this, and this. And maybe that's not the best outcome for your future self either. And so it could be because of positive things or negative things that you have some emotional ties to. And the reason that you bring a third party in, they can kind of help look at it from an objective perspective and say, these are what you actually should be doing. So I would say even if you do have a deep understanding of finances, it's always good to have a third party to help you cut out the emotion of it. And then if you don't have a deep financial understanding, I would say definitely having a third party to just help you, because that gives you a quick way to get up to speed on this is the stuff that you need to be focusing on, and this is how. You could definitely do a lot of personal research and do a lot of understanding. YouTube's great. There's a lot of resources on podcasts and online. But at the end of the day, a lot of people are busy. A lot of people have their job, their family, their life. Probably the last thing you want to do is becoming a personal finance expert in your free time. And so because of that, hiring someone to be a third party that can help you with emotions and then also help you get up to speed faster, it makes a lot of financial sense.
Yeah. I've got lots of questions. How do people pay for financial advising, especially if they're like living paycheck to paycheck? How does that work? If they feel like I'm already struggling financially, I can't afford to pay someone for this extra service. I'd rather, tough it out on my own.
That's a really good question. And it depends on what level of service you need. If you just need some more general advice and some basically like financial planning that needs to be done, and you're like, if we get a financial plan in place, I'm motivated, I can keep going from here. That could be one option. Maybe you spend a few $100s to maybe like $1,000, $2,000, and you put together a great financial plan, and then that's basically your payment. And then maybe in the future you have not monthly, semi-annual or annual meetings, and it's going to be pretty quick, but you're basically just checking in to see how things are going. That's one option people take, and that kind of defers expenses long term. Another option people do is they will get a financial advisor that helps them with their investments. And that investment side is mostly retirement investments. And what's nice about that is you're putting money away, but the financial advisor usually charges a fee to manage your money. And when they manage your money, you also kind of have access to them to have some resources of like, hey, I'm doing this. Can you help me with this or something like that? Sometimes financial advisors will charge you like a consulting fee for that, but sometimes you'll work with them, especially if you have a decent chunk of money as it grows. They may just say, all right, well, I'm charging you for investing. I'll do some one-off help with you on that as well. And that could be an option where you're already putting money away. It's not really coming out of your daily budget for paying the advisor because they're already charging you for managing your portfolio. And you also kind of have access to them for some of these questions. So I've seen it both ways like that. But I would say if you're just starting out and you're like, I don't have the budget to pay for an advisor to do a bunch of consulting for me, what you should do is start with a small chunk and just start investing with an advisor. Start with a relationship with them, and then you never know. You ask them a question, and they can kind of help you guide you in the right way. That could be a good starting point. And then as you build up, then you can maybe have more consultation fees or really sit down and do like a full-on financial plan, and that can help you for years to come as well. the more in depth is definitely costs more, but at the same time, it could be really beneficial. A few hundred or few $1,000s in the beginning, if you're looking at the course of your life, is really not that big of a investment, and that could really pay off dividends in the future. So I would say to start off, though, definitely starting with, even if it's a small portfolio, and trying to get access to an advisor early on would be helpful.
Yeah. What questions should someone ask, or if they're researching like their options? People, a lot of people have like different banks that they work with, and some of those banks offer financial advising, but as we know, not everything's created equal. So when a person's researching, who they should go with, or the company, the certifications, what should they be looking for? What questions should they ask to see if someone's legit, if someone's going to be a good fit for them?
Great question. I would say first start would be asking what kind of credentials the individual you're working with are. All advisors, at least in the state of Ohio, have to have a minimum of a Series 65 as basically a license to allow them to be an advisor. There are several other licenses you can build up over time, and some of them are very specific, some of them are very general. And so trying to understand what credentials they have, and it's as simple really as they send you what the credentials are, you can just Google what that is. Things that are really to know that the person has invested time and energy and money to get to where they are. If they have a CPA, CFP, or CFA, especially in finance, you will know they know what they're talking about, because it's pretty rigorous to get either of those. If they have multiple of them, then it just keeps layering on how qualified they are to be discussing with you your finances. And we haven't touched on CFP. CFP is a certified financial planner, and it's really more of a mix of long-term goal planning for finances, especially as you start getting into estate planning, and if you have a business and you have all these different things that you want to be working on, they can really help you map out that. And so if you are looking for that specifically, definitely recommend looking for a CFP. But if you're looking for tax or business type advisory, CPA would be good. CFP may help a little bit with that. But then if you're looking for like deep dive investments, you can look at any of those categories. CFA, I would say, I'm biased on that, but it's definitely CFA is one of the most highly regarded in the investment field.
Awesome. What are your suggestions going back to like having a limited income or very tight budget? How does a person make a decision for if they're going to invest, how much to invest, again, when they're just very limited on financially?
Absolutely. It is challenging when you're living in a tight budget. And trust me, I've experienced that, and especially early on in my career, a limited budget and trying to invest, but also trying to make bills, and then also trying to have fun too. And so it is something that it is challenging in the moment. I would say something that it's contrary a little bit to what you might hear in norms, especially in financial media or anything that you might be reading. A lot of times people look at it and say, all right, I have this budget and I need to cut back some expenses because I need to make this payment, or I need to cut back expenses because I need to save more, that's a good mindset to have, because you don't want to be spending over your means. But if you've got in a budget that you're in a good spot and you're like, all right, this is the best I can do, and if I cut any more, it's going to start hurting. Your focus should really be on increasing your income as much as you can. That might be taking on a part-time job. That might be helping out with something, or maybe starting a side business that you do. But increasing your income makes more sense than trying to cut down more of your expenses. And it's great, but that's also, you have to start out with a budget. If you're not starting out with a budget and you're like, I just need to increase my income because I'm not making ends meet, well, it might be because you're spending on things you shouldn't be. But if you've already had a budget in place, instead of trying to cut things more, you probably should focus on how can we bring in some more income? And that, I think, especially nowadays, there's a lot of things you can do, whether that's virtually or working remote, or even like some part-time jobs that are more contractor based. Bringing in some extra income is really important. And I would say if you're at a spot where you're basically you're meeting all your expenses, but you're not able to save anymore, it might be something you should consider of, maybe I work an extra 5 hours a week and I just put that money directly into investments. Mm-hmm. And it's challenging sometimes to say, well, I'm working my butt off. I don't have time for that. But if you really want to make long-term improvements for yourself, it might only be temporary to work part-time for a little bit, and maybe you get a raise at work, or maybe you get a promotion, or maybe if you're starting a business and you just need to have a little bit more income just to get you to the next level. Those are the things that if you can really increase your income versus trying to cut back in expenses, that can really help you out with trying to do some more saving or investing.
Yeah. How do you factor debt into that? As well as like that tight budget, because I've experienced and know lots of people that have experienced, like, I'm barely paying the bills, mm-hmm. or I even have some bills that have gotten past due, that I'm like trying to pay catch up, or got big credit card debt, or just old debt, like you said, credit collections or something like mm-hmm. that they're trying to navigate through. And then to say like, oh, I'm going to invest on top of that might seem like unreachable. What sure. would your suggestions be at that point of, maybe it's not, I'm financially stable, but I'm like financial crisis, like struggling.
Yeah. Yeah. And that's the reality of a lot of people I've talked to. I would say if you can, even if it's $5 or $10 a month, if you put it in a low cost investment account, like Robinhood's a good example. If you don't really want to pay for an advisor and you're just like, I just need to start something to get the ball rolling, open a Robinhood account. It's free. You can put some investments in, buy one of the Vanguard ETFs, mm-hmm. and just start. That will get you in a habit of investing, even if it's only $5 or $10. And the reason I say one of those low cost ones is, if you went to an advisor and say, I only have $10 to invest, they may say like, hey, come back with you have like 1,000 or something. Yeah. Some people may help you right away, but some people may not. And so if you can just get yourself to get the ball rolling, even if you don't know what you're doing yet, just Robinhood is pretty user friendly and it can get you in the right spot to just start. And then in the meantime, try to invest and aggressively pay down your debts. But even if you're putting small chunks of money away investing, you are doing that to get yourself in a routine. And as you pay down debts, you'll have more income and more discretionary spending that you can put more of that money towards investing. And so I would say that's one focus for sure. But then also, it depends on what kind of debts you have. If you have credit card debts, interest rates are very high on those. Yes, we should aggressively pay those down before investing aggressively. But if you are focused on, like, I want to pay my student loans down aggressively because I want to get rid of those, that's a great goal for sure. But if your interest rate on your student loans is like 4% and your roughly the average stock market return is like 8 or 9%, depending on what type of environment we're in, you could be earning more money by aggressively investing versus paying down your debts. And I think that's hard for people to grasp at first, because they're like, well, it's not good to have debt. Some debt, yes, it's not good to have. A credit card debt, their interest rate's 20-some%. It's going to be really hard to find a great investment that consistently gets you 20%. And so that situation, aggressively pay down the debt. If it's a 4 or 5% student loan, might make sense to not aggressively pay that down and more aggressively invest if that's your goal. So it depends on what debt you are looking at too. But in general, I would say just starting small and just getting a routine. And as you get more income coming in, increase that money you're putting towards investments.
Yeah. You bring up another question that I have. I hear very mixed messages about debt, and like there's good debt and bad debt, or, have no debt at all. What is your philosophy on debt? Is there such thing as a good or bad? And if you think that there is, how can you tell?
Sure. Great question as well. I would say I view debt personally as there's debt that can increase your ability to bring in money, and there's debt that you're paying for future expenses that is going to harm you. Um, the harmful debt is more of credit card debt that you may be buying something now and it might be more personal, or it might be something, maybe it's for your business, but it's not as helpful for your business. That could be something that is negative because you're paying high interest rate one, but then also you are basically paying for future or current consumption in the future. And that's just lowering your future income. If you're taking out debt, whether that's for student loans to increase your future income because you're investing in yourself, or maybe you're taking out debt for a house, but you will have more of a fixed payment versus renting. So renting, usually you see every year your rent will go up. But if you have a mortgage, your mortgage, most of them are locked in for 20 or 30 years. You're going to really put yourself in a better position in the future as interest rates increase or decrease, or inflation increases or decreases. Your monthly housing payment's going to stay about the same. So that's going to help your future self too. Other examples are if you have a business and you're like, hey, I need to take out a loan because I want to invest in this project that I really believe is going to increase my business, increase my future income. That could be several different things depending on your industry. That also is good debt. Some things that I'm more on the personal side too is maybe you're looking at purchasing a car and maybe you have to take out an auto loan for it. If you're in that position, that could be helpful because you need a car to drive to work, but you don't need to get a Mercedes if you're not in a position to get a Mercedes. So definitely gauging like, all right, if I need to buy a car for this, or I need to buy something, I need to take out some loans for it, making sure you're in a position where that monthly payment isn't going to harm you. Because a lot of times people, they're like, hey, I need a car. I want the nicest, newest car. It's not necessarily what you need to do for your future self too. So I view it as if the debt could be something that can potentially increase your income or potentially help your future self, that's a good debt. Anything that you're paying for paying in the future for current consumption, that's not a great debt to have.
Yeah. I mean, Evan, you're preaching. So to run that back, you said really thinking about your future self. And is this debt going to set me up in the future?
Mm-hmm.
Or am I just buying something in the present?
Mm-hmm.
Paying with future money. It reminds me of just the old saying, you don't count your chickens before they hatch. And
Right.
so you're like spending future dollars that you haven't earned yet for something that you're buying now, really examining, is that a frivolous expense? Or is it something that is benefiting my life in a really meaningful way, and ideally something that can bring me more money? Yeah.
Absolutely.
Yeah, that makes sense. That's going to stick with me for a minute.
Good. And I will say too, with credit cards in general, like I use credit cards. I don't think credit cards are bad as long as you're paying them off consistently. You can earn rewards. It's a great way to spend money, but you should be careful on what you're putting on a credit card. And that's right to your point. Like if you're buying things that are more frivolous on a credit card, probably not the best financial choices.
Yeah. Piggybacking off of that, how does a person calculate risk? I think that was very clear, how you explain that in terms of debt. But if you say like, okay, should I take this job versus that job? Or, I'm going to move, and the cost of living and just the different financial decisions that we have to make. How do you decide if it's a risk and calculate how big the risk is?
Yeah, great question. And that's challenging because risk takes a lot of different forms. It could take financial risk, of course, but then also you could have missed opportunities. You could have other types of risks that might be like more on personal side too. Like you might be missing out on relationships with family or friends if you're doing like a location move or something. I would say if you're looking at financial risk, let's say the example you just said with you're looking at a job that you maybe take to a more expensive cost of living place. And I actually did this analysis before. I was considering doing a job. This was years ago now when I was still working in corporate America. I was considering taking a job in Chicago, and I had my current expenses. And basically what I did, I contacted some people that lived in Chicago, try to get an understanding of the taxes they paid, try to get an understanding of like, if I lived in a similar type lifestyle in Chicago, what would that be for my annual expenses? And I broke it down monthly. And I looked at that, looked at how much my taxes would be in Chicago. And it basically gave me a ballpark of the income I would have to make there to have the same lifestyle essentially where I have now. If you are taking a job and that income is lower than that amount, you're probably going to be taking a risk doing that. If the income's higher, then you could potentially be increasing your lifestyle if you did that too. So that's one way to look at some financial risk if you're looking at a business perspective or a personal perspective. From a business perspective, I like looking at it in a financial, I call it a financial modeling exercise where basically put down how much projected income you could do with this business. What is your projected cost for the business? And then you can kind of see a profit. And so, of course, it's projections. You don't know in the future or the future of the business at all, but you can kind of get an idea of what this could be. Could run a couple scenarios like worst case, best case, and then you get a picture of what the business could be. That looking at that, if you're comfortable with those numbers, then that's a good risk to take. If you look at it and you're like, this is worse than I was thinking, then you're probably shouldn't take that risk. And then also on like looking at it from a financial risk side, if you're investing money that if you lost it all tomorrow, that would negatively affect your life. You probably shouldn't be investing aggressively. You can invest in safer things, like for example, government bonds. Depending on how you view the government, government bonds, especially short-term ones, they're essentially risk-free. In very limited circumstances can I see the United States government defaulting in the next year. Yeah. But there's always a very small risk that could happen. So in general, those are some of the safest things you can buy. And so if you're like, hey, I want to invest, but I don't want to be super risky, short-term government bonds are given 5% interest right now. If you're making 5% on that versus doing almost 0% in a bank account, you probably should move money into that as long as you don't need that in the next 6 to 12 months. But if you have money and you're like, hey, I'm putting this away for like 20 years, and if I lost half of it short term, I would be fine because I know this is a 20-year investment. Maybe you can take some more aggressive risk with that because, we've seen over the years, stock markets go up and down, and sometimes they go down aggressively. But if you pull your money out that time, that's the wrong time to pull it out. You want to keep letting it go. So risk is tough because there's a lot of emotion involved in finances, and some people make poor decisions in the moment when emotion's involved. And so trying to lay out as much as you can early on to try to see, does this make sense financially? Does this make sense for what I think could happen? And if you're comfortable with all those things, I say take that risk. And sometimes it pans out great, sometimes it doesn't, but you can use that to learn for the next time too you're doing it.
Yeah. Let's assume worst case scenario, someone's made a bad investment, or they've been managing their finances poorly, or just have high expenses and very low income, or just some of those challenging things, and it's going all wrong and bad. How would you recommend someone to start to recover from those bad investment choices or that poor financial management and start to right the ship?
Yeah, that is challenging because you not only are getting over like a financial loss, but you're also getting over an emotional loss too. And I mean, I've had some bad investments in the past, especially when I first started out, and you kind of have to jump a hurdle to get back into it. But I will say this, trying when you're investing or taking risks or starting business, inevitably you're going to come across something that is going to be a negative setback. Um, if you're able to get some of those negative setbacks out of the way on a small scale and try to see how you react to them, that can help you for the future understand how aggressive you need to be if you're investing, starting anything, working your own business, whatever that is. Because if let's say you had $1,000 invested and you lost half of it, if you were invested aggressively and you lost half that money, $500, yeah, it's not fun to lose $500, but say that was $1 million and you lost half of it. That's going to be way harder to stomach. But say you lost it at $1,000, you lost half of your investment. In the future, if that's terrible experience for you, in the future, you're like, all right, I'm not going to invest as aggressively, but I'm going to still invest. That is something that we have to have conversations, especially if you're working an advisor. You have those conversations early on to try to understand, because as an advisor, their duty is, if they know that you are more risk averse and you're like, hey, I don't like having things that could lose a material amount of value quickly, then their duty is, all right, these are the options that we have, and these are the return potential you have for that. And if you're comfortable with those options and that return, that should be what you're investing in. If you're like, I want a higher return, then you're going to have to say, all right, what is my trade-off? I'm going to have higher risk, but I also have potential for higher return, or I want to sleep a little bit better at night, I'm going to have lower return. Right. Unfortunately, in this world, you can't have both. Some places will say they can give you both, but it may be because the risk hasn't happened yet. And so just knowing that going in is important, because if you do have a setback, one of the best things you can do is kind of regroup, maybe talk with someone who's an advisor, a third party, and just trying to understand what went wrong and if that was something in your control. And then if that is something you're like, I never want to experience that again, dial it back to your risk. If it's something that, all right, I understand what happened and this is what I want to do moving forward, maybe you don't need to dial back your risk. Maybe you just need to get back into it and just keep going forward. And it just really depends on how that setback affected you emotionally and mentally.
Yeah. How do you support people in that emotional piece of it when, it's all gone sideways? And how common is it for like recovery to actually happen? One of the things we've talked about in the class is financial trauma and generational financial trauma. So sometimes people have encountered, my whole family has really struggled with money, and I don't know anyone personally that is wealthy. And so setbacks are common and people don't get over them. So how common do you see with like people that are working with you that are focused on that recovery? How common is that recovery to happen? And how do you help people keep their cool when it's, again, the bottoms come off the ship?
Yeah, absolutely. So the amazing thing is we were created with a very adaptable mind. And a lot of the times that, especially if it's a generational thing, you've grown up and your family and your grandparents and all this, they did something a certain way. It doesn't take a ton. It might take some time and some coaching, but you're able to have a mindset change. And if you're working with someone who's an independent third party and they're kind of guiding you through what you should be doing, and we start small, I would say it's really hard to not change your mind. It may take some time, and some people it may take a lot of time. Especially if they want it, they're going to be able to move forward, especially with the help of a professional, to move in the right direction. And that could be with anything. That could be with investing, risk, credit cards, anything that you're doing financially. If you want it and you have the help of a professional, you're able to have a mindset change. It's just going to be gradual, and you just got to work towards it. And sometimes you may take a couple steps forward and a couple steps back, and that's okay. But if that happens and you're taking a couple steps back, understanding where the mistakes happened and how to correct them in the future is important. And that's why it's good. And I like having more regular meetings with clients, just because it's helpful to just see where their head's at, see what's going on. Because the worst thing I've seen is financial advisors sign someone up, they don't talk with them for like 2 years, and then the person's like, the client's like, yeah, I have one, but I don't really talk with them. Like, well, why are you paying that individual if you aren't even really talking with them? And so it's important to find an advisor that was going to regularly check in on you and then guide you through things. But then also, as if you're going through that stage of, I'm growing out of a mindset I used to have and growing into one that I want to have, having regular and transparent communications with the person you're working with is important, because it's hard to know what's going on in someone's mind when you're only having brief conversations with them without knowing them super in depth. And so if you're very transparent at the beginning, is like, hey, this is something I'm struggling with and this is what I want to work towards, that gives them the professional understanding, say like, all right, this is what I need to do to help guide you in that direction. Versus if you're like, you're holding that in and you're not sure if they understand where you're at or not, that's a lot harder to move in the right direction. But really, I think with financial literacy and financial habits, you're able to move in the positive direction as long as you want it, and as long as you have a clear guideline to get there. Those are the two things, and I believe almost anyone could change the situation because of that.
Yeah. So it sounds like similar than my profession in counseling, that the more transparent and vulnerable that you can be of like, this is the situation, truly, then the professional is able to like really work with the reality of the situation, no matter how, stark it might be, and help give those like guiding principles and plans, uh, and can help. If you say like, I want a really aggressive plan, or I just need to take it a little bit more easy, can help give that guidance, versus feeling stuck.
Absolutely.
Yeah. What would you say the difference between like a financial goal and a financial plan is?
So I would view a financial goal as one like specific item that you would like to do. And that might be buying a house, that might be paying off debt. Really, it's one isolated thing you'd like to do. And a financial plan is more of all those isolated things in line and with a time frame and how you're going to get there. And so a goal is more specific and isolated, and a plan is more all-encompassing and has multiple different paths on how we're getting to each of these goals and how they're layered in on top of each other. And that's how I view the plans. Plans are a lot more in depth, take more time to map out and more conversations, but you are going to have a lot of financial goals on the way that you can kind of build momentum towards.
So like the plans, the big picture, and the goals, like something specific. So you might even have multiple goals like within the plan.
Exactly.
We've been talking about the importance of like prioritizing what's most important to you. So you might have like an order of things, or prioritizing what those goals might be. Yeah.
Definitely.
Yeah.
And with that too, if you have financial goals and you're putting together a plan, like you said, with the priorities, make sure those are aligned with your values and beliefs too, because that is so much easier to keep moving forward, even when things are a little bit more challenging. Versus if you're like, hey, this goal sounds great, let's do it, but I'm not aligned with that. When things get challenging, those are easy to throw out the window, because you're like, I'm done doing this. This is annoying.
Yeah.
When it's more aligned, it's going to keep you more on the right path.
Yeah. And that's a very good point in terms of like the motivation when you're really working the plan. And then it might even be a sign, if you're ready to like throw it out, or if it gets hard, you stop working the plan, working towards the goal, that you really need to do a gut check, sounds like, to be like, all right, what am I doing? And is this, align with who I am as a person, what the value, what I'm valuing or prioritizing in my life. Yeah.
Absolutely.
What resources or tools would you recommend to people that are just starting in trying to increase their financial literacy? Like you said, they might not want to commit a decade into learning all the things that you've learned, but they do want to be more knowledgeable. What would
Hmm.
be some entry point resources that you would recommend to people?
Sure. So, a couple of things I like. I love podcasts, and so there's a couple podcast resources. I can share them with you if you wanted to put them in any of the show links.
That'd be great. We'll
But
definitely list them in our resource section. Thank you.
definitely. So yeah, there's some podcasts, and they cover investing, some personal finance stuff, and then if you wanted to get more in the weeds of like something specific, let's say real estate or like deep dive investing, there's podcasts for that too. So definitely look in podcasts if you're interested in that. And then there's also some really good books, whether you're an audiobook person or just more of a classic book. One of them I actually helped teach a class. It was probably 6 months ago now.
Mhm.
That we used a book called Clever Girl Finance, and it was actually a really good book because it covered a lot of the basics and went into enough detail that you felt good about each of those specifics. You talk about budgeting, investing, different investment accounts, credit cards, all the stuff that you could think of, and it put it in really good bite-sized chunks. So books like that are really important too, to just get like a base level understanding. And then if you wanted to go a little bit deeper and try to understand like good financial practices, um, I I think there's people have mixed feelings on it, but in general, Dave Ramsey has some really good financial practices. He had some books out there. He has some shows, but in general, his practices are really they're conservative, but they're very good financial practices. I some of the stuff I don't align completely with. Like I know he doesn't like credit cards at all. Like I said earlier, I don't think there's a problem with them as long as you pay them off. But if you wanted to have like a good financial practice methodology, he's a great resource to look into.
Okay, that's awesome. What would be your suggestions, resource wise, in terms of like investing itself, or where to
Hmm.
start? Kind of the only things I feel like that generally that you hear are like stocks and real estate. But I know that there's other things outside of that. Um,
Right.
Lots of information, even in just those two categories. What would be a starter resource for investing?
Sure. So actually, that Clever Girl Finance book has some good starting resources for investing, and then also it depends on like what kind of, like you said, what kind of investments you want to have. I would say if you're first starting off, the best thing you can do is to look at investing in what's called an ETF, exchange traded fund. Those are low cost. They give you access to hundreds of different stocks at one time. So you only have to make one purchase to invest in those. And you can get a lot of that information on, let's say, a couple of examples, but like Morningstar or Yahoo Finance. There's some good information there that's free that you can just read up on and understand it. I would definitely start at the ETF level. And if you wanted to go deeper, then you can start researching into like individual stocks for investments. That's a lot of the information you can get is free for that type of stuff. When
Um,
you wanted to go more specific into real estate or bonds or private investments or investing in other companies, those are a little bit more challenging. That gets really more specialized too. And
mhm.
so definitely you can find some resources to read online, but I would say trying to consult with an advisor first before you start diving into some of those, because the reason being, some people, and unfortunately, this is unfortunately the case just with finance in general, there are people out there that like to take advantage of people that don't have enough
Mhm,
knowledge.
mhm.
And you may say, I've done some research, and we saw this a lot with cryptocurrency
Yeah.
in a few years ago. A lot of people, they're like, this is the next best thing. I'm going to invest aggressively. And they lost a ton of money. And those things, unlike stocks, they're a lot harder to recover. Some of them, like Bitcoin, has gone up and down aggressively, but it's recovered generally. but some of those very specific cryptocurrencies still have not recovered. And so I would be wary if you're new into investing, going too deep into some of those specialized things without some guidance, just because there are people out there that specifically target people that are just learning and they try to take advantage of them. And that's the unfortunate thing in finance. So I would just say, try to stick with stocks first, try to get an understanding. And as you start branching out, maybe bring in an advisor and just kind of soundboard some things. And if you find something that comes up or someone's telling you about something, it's really good to soundboard it versus trying to dive in or look at message boards or something like that. It's definitely a dangerous road if you try to do that by yourself.
Yeah. So it sounds like coming back to risk again and getting into the shallow end of the pool to get yourself,
Yes.
acclimated into investing. And then as you're learning and growing, you can go into the deeper end and the more riskier it is, the possibility of better returns, but also the greater possibility of loss. And like you said, maybe some more shady characters in the deeper end. You want to stay away from the sharks.
Yes.
I've had this analogy explained to me before about the ETFs that is kind of stuck with me, is if you consider the ETF like a basket and a bunch of different eggs in there, and the eggs are different companies. And you might have a bunch of like real estate company eggs in there. You might have in your basket the Fortune 500 companies in the US, or just different types of company grouped together. And it's a little bit more safer because one egg might break, but you still have enough to, make an omelet or good souffle or something, versus like an individual stock. It's just the one egg, and it might be able to put Humpty back together again, but it might take a little time. So I just want to share that with, our audience, because that's kind of stuck with me, to be able to kind of visualize like what is a ETF. Again, these words that we might hear, but to start having a better understanding of them. Yeah.
That's a perfect picture of it too. And I like how you just it basically condenses it into something that's easy bite size that you can grab, and it makes something that sounds very complicated very easy to understand. So I like that analogy.
Yeah. On that lines, when people are starting to get more serious about their finances, increase their financial literacy, what would you recommend to them if they start to feel intimidated into like the alphabet soup, and they're hearing these horror stories of people getting ready to retire and they lost it all, and the scams and things like that? What would you recommend in terms of like that fear, intimidation of like, I'm not like you that have all of these qualifications. What could I learn on my own?
Yeah. So I would say it depends on what you're trying to accomplish. If you're just trying to understand like financial markets in general, having some uncertainty and fear with that, as long as you're not putting money into it yet, it's fine to have that, because there's a lot of unknown with it. You're trying to learn and grasp things. And so again, going back to, if you come across something that you're like, I feel like this is not right, maybe consulting someone that has some financial knowledge or an advisor would be really important before you do anything with that. If you're getting into something where you're actually investing money and you're starting to feel overwhelmed, whether that you're doing it on your own, or if you're, let's say, you're on Robinhood and you make some investments and you're getting stressed out, maybe that's a time to start stepping back and saying, all right, do I feel comfortable with the knowledge level I have on this that I'm doing? And if you're feeling overwhelmed, maybe that you don't feel comfortable yet, and maybe that's time to either do some more research or consult someone that can help you further become knowledgeable in that. And I see that a lot with when people start investing in stocks. They find out something called stock options, and they get into stock options because they see, wow, this person made thousands of dollars in one day doing it. I want to do that too. Stocks, look at a stock investment of, I want to own this company and own it for years in the future. Day trading, stock options, there's a place for that in financial markets. I will say that most of the time, just like a casino, most of the time with day trading and stock options, the house wins because
Yeah.
it's set up that way. There's things called market makers, and basically they buy and sell these aggressively. They make money whether you win or lose. And
Mm.
so with stock day trading and options, be very careful when you hear success stories on those, because those are set up for you to usually lose at the end of the day. There are people that have become professionals doing that, and they make a lot of money and they do very well for themselves. But the average person that has not devoted their entire life to doing that, don't expect that to be your way out or making a ton of money. I would say stick with stocks right now, ETFs, and have a very long-term mindset with it, and try to avoid some of those pitfalls that early on investors, because what happens a lot of time, and it happened with me too, you buy your first investment, it does really well, and you're like, this is amazing, I want to keep doing this.
Yeah.
And you start overdoing things, and then things go south. That's usually when people start like, all right, I'm doing something wrong. That's when you either need to step back and try to understand what you're doing wrong, or consult someone that can help you.
Wow. Yeah, so being able to again, back to that gut check and be able to see, like, am I over my head? And if I'm feeling like that, reach out to a lifeguard to
Yes.
get resources before you get into too deep. Yeah.
Absolutely.
Yeah. Any other nuggets that you want to share with us that we haven't covered?
So I would say for people that are business owners right now, I would say it's really important, if you have not already, consulted with someone that could either help you on the financial side of your business to try to understand where your business is heading or what you need to do currently to help improve your business. I think that's something that's really important for business owners, because I've come across this so many times where a business owner, they're successful and they're like, hey, I need help doing this. And then I like open the lid and there's such a disaster of stuff. And I'm like, how did you guys not notice this? And they're like, well, we've been doing well, so we haven't really paid attention.
Yeah.
And I think finance usually comes on a back burner for a lot of business owners because it's not something they're trained in. And then also their focus is, I need to build a brand, I need to build my business, my income, which is great focus. But if you ignore the finances, that over time gets worse and worse, and then it causes issues. So if you can get ahead of that early on as a business owner, trying to understand your finances, trying to keep yourself organized, and then try to understand where you're going from a financial perspective is really important. And then from a personal side, I would say on the investing specifically, it's never too early or too late to start, and it's never too early to start. And so even if you have a small chunk of money and you're holding it in a bank account, and you're like, I want to invest this one day, just start now. Don't be super aggressive and put in just one stock, but like start with the ETF approach. Definitely pull in a financial advisor if you want to go that route, because that can even just help you kind of take it off your mind, and you're like, hey, someone's helping me do this right now. I'm going to have check-ins, but I trust that person's taking care of me in my best interest, and I can just focus on what I'm doing. And that kind of just alleviates a lot of pressure with it too. But definitely start, no matter what amount you have, to try to get in that routine, because it's just really important to let yourself have as much runway as you can being invested, whether that's stocks or bonds or anything else.
Right. You mentioned it's never too early to start. And I definitely work with young people, like 18, 20 years. What would you recommend in terms of them to start, because they could like have a good chunk of time to be able to get
Absolutely.
what would be a starting point for young adults? So they might be still in college or, working a summer job. So they might not have a lot, again, to invest, but want to get started.
Yeah. I would say for someone that's young, and this gets into like a little bit more specific stuff, but I recommend this for everyone, but it depends on your situation and which one you choose. Starting a retirement account, and sometimes you'll have a 401k at work, but if you're self-employed, there's different options you can do for your retirement account. But if you're young, like say you are between 16 and 21, and maybe you're not out of school, or if you choose not to go to school and you're doing something else, if you started a Roth IRA, you are putting after-tax dollars into it. But usually at that age, your tax bracket is very low. So you're not paying a ton of taxes on the money that you're making anyway. The requirements for the Roth are you really just practically just have to have an income. So as long as you have an income, you're able to put money into this. Any money that you take out of that when you retire is tax-free. And so if you started at, let's say, 18 and you put $1,000 or $2,000 into this, and you did that every couple of years for your whole career, imagine how much money would be in that, especially as it's grown over 40 or 50 years. And then all that money is going to come back to you without paying taxes on it. And so, especially if you're young, take advantage of having a very low tax bracket. Take advantage of putting money into some of these tax deferred accounts or non-taxable accounts that over time are going to do really well for you. And then on top of that too, a lot of these retirement accounts, you get penalized if you take money out. So it kind of gives you an incentive not to touch that money. And if you have an incentive not to touch the money, you'll usually keep it invested and let it keep going. And that's only going to be beneficial for you long term.
Yeah, that's awesome. Thank you again for all of this wealth of information. I know myself, I cannot wait to come back and watch the replay myself. I've learned so much, and you gave a lot of good things for us to think on and to start applying right away, which I really appreciate. If people are interested in contacting you, or they have more questions about what you've shared, or they're ready to get started, what is the best way for people to reach you?
Absolutely. And I appreciate you having me on here today. I love talking about finance, and I would love to talk to anyone that's interested, even if it's just a quick phone call to talk about any question you had. I'd love to have that opportunity. So best way to reach me is either through my website at tetelestaicapital.com. Everyone asks me how to spell that or what that even means. So I'll send that to you, Esperanza, if you wanted to put that in the notes as well. But best way to reach me is either through my website, or you can call me. My phone number for my business is 614-758-7506. Happy to have a conversation with you and meet with you if that's something you would like to do virtually or in person, just to understand your situation and how I can help. But love to meet anyone that is interested, and I look forward to future classes as well with you at Esperanza.
Awesome. Me too. I've learned so much, and I am really excited to share this with everyone. With one follow-up question, I know for counselors, we are limited to the state of where we're licensed and the people that we can serve. What about you? If you have, if somebody's reaching out, or one of the students are someplace else, like outside of Ohio, how does that work?
Good question. So for finance and advising, the only limit I have is as long as I have less than 5 clients in each state, I don't have to get licensed in that state. If I have more than 5, I just have to submit some paperwork to get licensed. So depending on which state it is, I'm probably good to go with it, unless I have to submit a license form. For tax side, and I really don't do much with client taxes anymore. I can guide you since I have a CPA license, but I really am limited to just Ohio with that, just because it's a state license for the CPA.
Okay, that is great to know. Well, thank you everyone for watching the replay, and thank you again, Evan, for your time and all the knowledge that you've shared with us today. I hope this is some encouragement and steps for people to start applying right away. And I would love to have you back to share some more information again in the future. So thank you again, everyone, for joining us. And until next time.
Yeah, thank you very much, and hope you guys have a wonderful weekend.